Hey everyone, I hope you can see me, hear me clearly. Just a very quick thumbs up if you can. Okay, great. So we'll start in a minute. All right, so we'll get started in just a minute. I install need to start after the course. Okay. So next week I'm good. Thank you, Mohammed. All right. Okay, so let us get started in a few seconds. And so I'll turn off the chat first and foremost. Okay. So it's like very hot in Delhi. Right? I don't know how many of you are from Delhi. It is really bad. I'm a coffee person, but I'm drinking like lemon water so that I stay hydrated during the class. The weather is like so bad. So it will be available for 1 year. So I'm actually shifting to Goa next week. So yeah, I leave. Right, it's a one-way ticket. So let's see how that goes. After that, I'll be in Kerala for a few months, and I'll keep on traveling. Okay. Cool. I'll try to organize a meetup also and go. Let's see. Cool, awesome. So let us get started, right? And the first, and basically like I'll point to 2-3 things first, and then I will get into the teaching. So now from this point on, our goal is very simple, that we are just going to focus on 3 things. Okay, should you buy or should you invest, right? When and what you should be buying and in how much quantity, when and what you should be selling and how much quantity, right? So these are like 3 areas that we will touch upon, right, throughout the entire course. It is almost impossible for me to bifurcate course, right? For example, there will be specific session that I will do um, on technicals, etc., etc., and I'll keep on explaining you the concept. But the point is that, for example, when I teach business analysis or when I teach fundamental analysis, there are too many concepts at play which I can't condense in 1 or 2 classes. And if I try to teach like 30 important concepts about fundamental analysis in one go, your brain will hurt and you will not like that type of class. Okay, so every now and then I will keep on switching concepts from technical to fundamental to technical, so that will be a more enjoyable experience. Okay, so first and foremost, let us understand the most important point as to why predicting prices is a pointless exercise. Okay, and then yeah, so why stock price, right, or predicting price in the stock market is almost an impossible exercise, right? And this is something that you should not be doing. That's one. Second, many of you are interested in futures and options, that, you know what, I want to become like a futures and options trader. I want to trade options, all that stuff, right? So please don't do it. I will see how I can okay. Right. So that is the second key thing, that please don't do futures and options, right? Very, very important point. Now, why is that, right? So can I give you an example and explain this? So this is an example that I love to give, and this is a very fundamentally important example. So please listen to it carefully, right? And this is a class today, which you should go and revise over and over again. So there are not many classes that I will say that go and revise, but this is an important class. This is a dense class. Okay. So, all right. So first and foremost, let us quickly understand that what exactly is the need for futures and options and why price prediction is almost an impossible game. Okay. So let us pick an example of 2 companies, right? So Maruti, right? And let us pick JSW Steel. Okay. So what is the relationship between these 2 businesses? Very simple, that JSW Steel produces steel, right? And it sells this steel to Maruti, and Maruti picks that steel, manufactures car, and people like you and I, we just end up buying those cars, and Maruti becomes profitable. Okay, so this company is in the business of selling steel, right? In short, right? And this company is in the business of buying steel. Everyone with me? Very simple concept, right? Nothing fancy. And majority of the spend of Maruti will be in materials. And one could argue that steel is the most important material for them in order to manufacture cars. Okay. So very simple example. I will plot it again, that JSW Steel is in the process of selling steel, right? And Maruti is in the process of, or its entire business model depends on buying steel. Okay. And if Maruti can figure out a way to purchase steel, or like, guess the prices of steel, then would it not want to purchase steel at the lowest possible price? It will, because it's a capitalist company. And similarly, if JSW Steel wants to maximize its returns, it would want to sell steel at the highest possible price. Okay. So this is point one that you should understand. Point two, right? So imagine a world where, now producing steel works in this way that, it takes time to increase your steel production capacity. So let's assume that we are currently in 2019. The price of the steel is, let's say, $1,500. Okay. Then in 2020, suddenly something happens and the price of the steel goes to $2,500. Now, JSW Steel will say that, okay, my profit margin is usually 10%. So I would want to sell more of steel now because the steel prices internationally have gone up. So I will benefit. But in order to increase this capacity, it will take them 1 or 2 years, right? They will have to build new factory, hire new workers, whatnot. Okay, so this is a second key point that you must remember. Okay, now comes a third important point, right? Now, basically what happens is that how will economy function per se, right? Economy will function per se if JSW Steel has an incentive to produce more steel, right? And Maruti has incentive to buy more steel. Everyone with me? Because that is how GDP will increase, right? This is the third key point, right? Now, what will be the problem for JSW Steel? So let's imagine that we are sitting in 2019. Okay, so I'll erase this part, that we are sitting in 2019. Steel prices are 1,500. JSW Steel is, let's say, has a production capacity of 100 tons. Right? So, and it is, executives there are pondering and they are thinking that, what, steel prices next year are going to go down and it will fall to maybe like 1,000 rupees or $1,000 per ton. So, our profit margins or overall profits will shrink. So what is the point of expanding capacity? So that is the problem that they will have. And they will worry about what? They will worry about price drop. Right. On the flip side, if you turn around the table, what is it that Maruti people will be saying? Maruti people will be worried about the fact that in 2020, if something happens and suddenly the steel prices go up, right, then we are screwed, right? I mean, our profit margin is like whatever, like 10% on a car. But if we have to pay 10% more on steel, our profit margin goes to zero. Right. So this company will not undertake capacity expansion, right? It will not increase its capacity because it is fearing that prices will go down. And this company again will not put out more factories. Why? Because it is worrying that someday the steel prices, or like, next year, steel prices might go up high. So what's the point of putting so much money in building a new factory? Okay. So how this problem is solved? This problem is solved into F&O market, right? So futures and options market. So both these companies enter into a contract. Okay. So both these companies say that, hey, you know what? We will enter into a contract. And right now they will enter into this contract in 2019. So Maruti will say that, okay, steel prices are 1,000 rupees per ton. I am going to give you an offer of 1,200 rupees. And we lock in the contract for the next 5 years at this price of 1,200 rupees. What will JSW Steel say? Okay, so let's say I've messed up the examples. I'll start it again. So in 2019, the prices are 1,500 rupees per ton. Okay. So Maruti gives an offer that I'm going to buy steel at 1,700 rupees per ton. Okay. Why 1,700 rupees? Because Maruti wants to undertake capacity expansion. Current market price are 1,500 and Maruti is able to sell this at Maruti is able to buy steel consistently at 1,700 rupees. Okay. JSW Steel, will it agree to this contract? It will say yes, that because in 2019, the prices of steel is 1,500 rupees. I'm getting 1,700 rupees guaranteed prices for the next five years. So I will also increase my capacity. And Maruti will also say that, okay, great. Now we are in a contract lock-in. We can be reasonably sure about our prices. So I will also increase my capacity. Everyone with me? Right, so far this is like simplest way I could have explained F&O. Okay, so this contract is called as a futures and options contract, right? So basically, In futures, it is done on an exchange. In forwards, it is not done on an exchange. It is done OTC, over the counter. Okay, so both of them shake hands. They agree to that 1700 price. Now let's imagine that 2020 hits, right, and suddenly the price of the steel goes to 2000 rupees, right? So who wins in this contract? Maruti wins because it gets to buy the steel at 1700 rupees, right? But should JSW Steel be sad, right? The answer is no, it should not be sad because it is selling more quantity as well, right? It would have never undertaken capacity expansion had they not agreed to this contract in 2019. It is just sad that, such a scenario played out. Also, opposite scenario could have played out that, suddenly the steel prices become 1400 rupees, right? So in this scenario, who wins? JSW Steel wins because they are now selling that steel at 1700 rupees and market price is 1400 rupees. So this contract could have gone anywhere. Now use logic and think about it from this way, that there's a lot of people, right? I mean, in Maruti, their entire business depends on what? One single thing. Guess the price of steel, right? Is it going to go up or down? On what thing does JSW Steel's business depends on? Just one thing. Guess the price of steel, right? They are into steel business all day long. They understand every single thing. They are into steel business all day long. They understand every single thing. Both of them, the very fact that they agreed to a contract of 1700 means that they are not sure about the exact steel price that is going to be in the future. And they also agreed to this contract and paid a slightly more premium from 1500 to 1700. Why? Because they are not sure, right? And then some retail investor will come and they'll say that, what? I know what the steel prices next year will be, and I'm going to short it or long it. Okay, so that is stupidity. It does not work as per logic. Okay, so therefore, guessing the prices of even one single commodity is almost impossible. So first and foremost, we should not invest in commodity stocks to begin with. For example, a lot of people said that, buy like sugar, buy like this, buy like that. No, please don't do it. It's a waste of your money. You cannot guess what the prices of sugar will be. That's the first key problem in terms of commodity stocks. Okay. Second key problem of commodity stocks is that, or I'm taking commodity as a proxy of prices because if commodity prices increases, it leads to inflation in everything, right? So that is the absolute basic thing. For example, it is almost, it is me like saying this, that okay. So let's say that, so it's called as value chain concept. Okay, value chain. Okay. Right. So value chain simply means that, okay, first and foremost, you will have sugar cane, right? Sugar cane. From sugar cane, what will you extract? You will extract sugar. What will you do with sugar? You will make a toffee, right, or candy. Okay. Then from that, what will you do? You will probably like go to Starbucks and make like, chocolate frappuccino or whatever, right? So you will make some kind of coffee, right? So this is the value chain, right? So for example, if the sugar cane prices go up here, then prices of everything will go up in the value chain. Okay. And what is the simplest price guess that you can make? You cannot guess the price of our product here, right? This is impossible to guess whether Starbucks will increase its coffee prices next year. That is pure mindlessness. You can somewhat take a jab at thinking about that, hey, whether this commodities price will go up or not. Okay, same goes for oil, right? So if you plot the supply chain of oil, again, you can try to estimate the price of oil. You can estimate the price of steel. So therefore, I picked steel as an example. Okay, and now I'm starting with the most simplest thing in terms of doing the price discovery, right, or guessing the price game, right? So here we have a very clear example that even companies that are involved in commodities, right, for example, Maruti, JSW Steel, they are taking opposite positions and they are locking their futures and options contract. It's a hedging strategy. FNO is a hedging strategy. It is not an investment strategy. People who teach option selling, option buying, they are just simply gambling. It is probably one of the worst gambling things that you can do. Can you make money in it? Yes. Would you also, not you, but in general, do traders also commit suicide in FNO? Yes, right? Why? Because they think that they will be able to beat things. And the highest number of suicides that happen in the stock market is done by FNO traders, right? So that is a simple viewpoint there. Please do not engage in these games. It's a highly dangerous thing for retail investors. I do FNO because of the fact that I can afford to lose that money, right? People criticize cryptos a lot. Crypto is not that big a gamble because you're dealing with very limited amount. It's an overall Worst case scenario will be you will lose your principal amount, right? For example, if you invest 100 rupees in crypto, it will become zero. You lost that 100 rupees, move on. Okay. In FNO, there is something called as leverage. So leverage means that you have borrowed money, you have traded on it, and there can be 20, 30 times leverage also. So which means that if you invest for 5 rupees, you can potentially lose 100 rupees. Okay. So that is the difference between crypto and that is the difference between FNO, right? So FNO is a much, much more dangerous game. And please watch my video today. It is about scams that run in the stock market. So which is a very important video, right? Which will help you understand a little bit more about the entire game. Okay. All right. So this brings us to a very simple concept that please do not engage in guessing or playing the price game. You will not be able to guess the price here. If JSW Steel people or Tata, Tata or Maruti people are not able to guess the price of a simple commodity like steel, you and I cannot do it, right? We can guess it, right? And we might be right, might be wrong, but there is no systemic way of guessing the price of steel, okay? Or for that matter, any commodity, right? It is just beyond our control, okay? So what is it that you should be doing, right? So first and foremost, now again, if we go to the value check and people not write, please, right? So I don't know how to turn off like writing on this. Please do not write, okay? Okay. So value chain concept, okay? And by the way, whoever writes, their name is there. So I will call names. Okay, so yeah, be rest assured. Okay. Right. So value chain concept simply means that, for example, you will have range of companies. For example, the first category of companies would be commodity companies. Okay. Then you will have first degree finished goods. Right. Then you will have second degree and third degree finished goods. Okay, so can I give an example? Very easy. For example, right, commodity, you can invest in gold. This will be step one. Second, a listed company which does, or first degree finished good would be something like maybe Rajesh Export. I don't know, right? Rajesh Export, right? A slightly more bigger brand than Rajesh Export would be direct D2C, right? So for example, it would be something like Titan. Okay, so if out of these you have to pick where you should be investing as a retail investor, you should definitely not invest here. Why is that? I'll get to in a minute. But you should be investing on this side of the equation. Okay, so this is one. So rather than buying oil or futures and option contract for oil, try to invest in a company that deals with oil. That is much better. Okay, so first, in fact, you should not deal too much in commodity oriented products. I will tell you why in a minute. And one of the prime reasons why I say that commodity oriented stocks are pretty much pointless is because of the concept of margin. Okay, so what is margin? So margin simply means that, for example, there was a project that I did with BCG and it was for a paper company, right? So paper company, and we were tasked with increasing the profit margin of paper company. Okay. So what was the problem? The problem was that that paper, they used to sell like 1,000 quintal or something like that amount of paper, so huge bulks of paper, right? And what was their profit margin? Their profit margin was 5 paisa per quintal, which is madness, right? So you're not making like any money on it. Okay. So these type of businesses are really bad, right? Now, but now you might say that, okay, Akshat, insurance is also like very low margin business. See, problem is not low margin. The problem is that with commodity, in order to sell insurance, what is it that a company like LIC or HDFC life insurance would need to do? They would need to have offices. They can fire their staff in 2 minutes, right? Startups can fire their staff in 2 minutes, bring down their cost. Okay. But if a sugar company is there, it will have 100 different factories, so on and so forth. Now, suddenly there's a crash in the commodity price. They don't want to produce it. Now, can they sell their land immediately? No, probably not. Would they not have to pay land tax? Would they not have to bribe the officials to run their factories, Bijli connection, all that stuff? No. Problem is that with commodity oriented businesses like paper business, oil business, coal business, sugar business, the issue becomes that they are very high cost businesses. Okay. So high fixed cost businesses. Okay. So they have a very high fixed cost, right? So any kind of commodity will have a very high fixed cost, plus it will have low margin. So this combination is a deadly combination. Please do not get into these type of businesses. It is really, really bad. Okay. On top of that, there are 100 different problems that go pay, like bribe government, whatnot, right? So all those headaches are anyways there. So this becomes like a very problematic scenario. Okay. Now you would see a lot of YouTubers giving commentary on that. Hey, sugar stocks are very good. Okay. Why? Because their book value is much better than the assets that they own. So what does that mean? Right. So let me just quickly explain that in a minute. What does that mean? Okay. So book value is an accounting concept. It simply means that, for example, let's say that I am a factory owner. I own 50 factories of sugar. Okay. So I have built like 50 factories of sugar, right? And so an accountant will come, they will do entire accounting of my business of 50 factories. And they will say that's your entire business is worth 5,000 crore on accounting books, because each factory, if I calculate the price of brick, the land, machines, all that stuff, it comes out to be 50,000, 5,000 crores. Okay. Now what you will see, right? You will go look at the CMP, current market price. And in fact, let me do that exercise with you. So let me take you to screener and then it will become clearer. Okay. Right, so let's take a look at any sugar stock. I don't even remember like sugar. Okay, let's look at this. Okay. Now, debt to equity means that the total amount of debt is 100% on it. Okay. So this is one. And book value, you will usually find 133 and current market price is 233. So this is slightly off. Okay. So usually you will find like book value around current market price, all that stuff. Right. So let us look at one more example. I don't even know. Let's do book value is this, current market price is this. There was a run in commodity prices. So therefore this is happening. Usually you will find it less than this. Okay, so almost this, right? So book value is almost equal to current price, right? So can you see this? Right, this is the book value, this part, right? 112, and current market price is also 124. So not that different, right? Usually what happens is that these stocks keep on going up and down quite a lot. Book value would not change. Okay, hardly it will change unless the company is selling its fixed assets. And what you will notice is this, that sugar companies have had a massive run up, right? From 40 rupees, this stock has 3x in a matter of 1.5 years, right? And why? Because commodity prices have gone up massively, right? Very high inflation environment. Now commodity prices are correcting. If you have any commodity stocks, please sell it off even at a loss, right? So that's the reason why I say this to people. First and foremost, you should not be buying it. And I will show you some of my trades where I took these type of trades in oil, right? So I purchased a bunch of oil stocks, benefited from high inflation environment, sold it off, right? Using the principles that I was telling the last time. Okay. So first and foremost, what you need to understand is that you will always have scenarios where, usually speaking, these companies here or here, what would have happened here? The book value would have been much higher than their current market price. Everyone with me? Okay. Book value simply means value on the books, right? That, hey, if you compute the factory, land, cars, all that stuff. So book value will be higher than the CMP, right? So what analysts will tell you, they will say that, you know what, just go and buy this stock, because even if the company gets bankrupt, it will sell all its assets, right? And if they give you back the money, you will still become rich. So this is the intrinsic value of the company. Now, this is a completely incorrect understanding, right? Why? Because when liquidation happens, it is called as distressed sale. Okay. So it's like, think about it this, that you have like 10 crores of loan on your head, right? And you have a very lucrative house somewhere in Mumbai. Okay. You are looking to sell it. Will you be able to get full price for that house if investors are on your head? The answer is most likely no, because you will have to undertake something called as distressed selling. Okay. So this is the primary problem, that please do not enter commodity stocks. Why? There are 2-3 reasons, and please don't get lured by this book value argument. It is completely incorrect, right? So ratios need to be used in context of the type of stocks and in context of the type of markets you're looking at. There is no math here. That book value, if it beats the current market price, go buy it. Or if PE is greater than 30, go sell that stock. Or if PE is less than 30, go buy that stock. Complete nonsense. Okay. So you cannot do such math. Okay. Here are absolute basics that you should know. For example, if you are picking any commodity stock, okay, number one, no one can guess the price, right? As I explained from the example. Number two, their entire business is literally driven by price, right? Think about it this way, that if you have to buy sugar, would you care if it is coming from Mavana sugar or if it's coming from Dharampur sugar? or it is ITC sugar. You will just say, "Bhaiya, shakkar kitne ki di?" Right? They will say it's 100 rupees or 120 rupees, whichever is less shakkar, you will go and buy it. Why? Because there is no concept of adding value on it. Okay. What is the concept of value add? Value add simply means that, for example, if I am extracting gold, right? Okay, so let me do a slightly different thought exercise and let me take your, and this is an example that you will remember. So I'll open up the chat box. Why do you think that farmers or majority of the mid-scale farmers are not rich in India? What is the primary number one problem in that? Okay. It's a very simple answer and it will give you what type of businesses to invest in versus not. Right? This is a very important lesson. Okay. Okay, can't control price. No, no middleman. No, nothing. Right? Very less. No. Food is essential. No. Right? The reason is, and I will close the chat box out, and this is an insightful point. Not smaller land problem also is not there. Right? The main problem in farming is that they are not selling. They are selling commodity products. Aloo is a commodity, but Uncle Chips is not. Okay. The profit margin on potato or onion for a farmer would be maybe 2%, but the company that makes chips out of it, its profit margin becomes 20%. Okay. So if you keep on selling commodity products, you will never become profitable. That's a simple point. And unfortunately, they are dealing in your wrong products. Farmers, instead of selling milk, they should sell cheese. Okay. So if they go home to home selling cheese, they will make huge profit margins. That's the change that they will need to make. Okay. But who is taking contract farming? It's multinational companies, Monsanto, whatnot, and they procure all these contracts at a very cheap price, right? Farmers also readily agree. But if someone basically just educates them that manufacture on your own, form cooperatives, manufacture your own local chips, you will have much better profit margins. They will become richer, right? But there is no one solving this problem because there are vested interests at play. And this is a business problem. This is not an execution problem that middleman is there. This is that. Of course, middlemen will always be there. That's not going to go away. But the point is that if you're selling a 2 rupee product versus a 50 rupee product, even if you have 4 middlemen, you will still make some money, right? But here the problem is that you're selling something in, yeah. So I hope you get the picture that at what side of the value chain you should be, okay? And same applies in terms of you being an investor. So you get a call, you get a choice that do you want to invest in companies that are dealing with extraction and selling of oil, extreme left-hand side of the value chain, or you want to go on the right-hand side of the spectrum and invest in companies which are making more energy efficient products, right? Using that oil, okay? So that's the same equation. So rather than investing in a company which is pure gold or gold-based company or buying gold, better to invest in a company like Titan, right? Why? Because there is a brand value play as well, right? So if you go check the price to book value, right? So here I showed you price to book value. There was hardly any difference in this sugar stock, despite it growing 3x in the last few months, right? So literally like in 24 months, it has 4x the stock price. Okay. And still the CMP is not beating the book value by a lot. Okay. So this is how horrible the situation is of commodity stocks. Now take a look at Titan. Okay. And take a look at the current price and book value. So book value of Titan is 105 and the current market price is 2000. Why is that? Why is that there's such a difference between these two things? So this tells you the power of businesses. The power of business is fairly simple, that there is a 1900 rupee margin between book value and CMP because of what? Because of one thing called as the brand value. Okay. So that's a simple message that I will give you. And this is a fundamental analysis point. And the key takeaway for you is that please invest in companies that are on the right-hand side of the spectrum. Please do not invest in companies on the left-hand side of the spectrum, even if they are bad. Okay. Now comes a second point, right, related to this, that should you be investing in PSU stocks, right? It really depends. Why? Because you will never have these type of situations where people are going crazy about PSU stocks that, current market price is 2000, book value is only 105 rupees. That is never going to happen, right? You will always have these type of dynamics play out. What happened in commodity stocks? So commodity stocks are not too different from PSU stocks, right? So that's the simple bottom line that I'm trying to outline. Okay. So here current price was 124, book value was 112, right? So again, let me pull up the example of PNB, right? So if you take a look at PNB, Punjab National Bank, current price is 29, book value is 88, right? Is PNB a very high debt company? When I say debt, it means traditional form of debts. Now, debt are also of two types, right? For example, for a bank, debt is the money that it is borrowing for RBI. So it is not debt in conventional sense. They will be able to pay it off, right? But when a FMCG company borrows debt, for example, a sugar company is borrowing money to buy like new land, that nature of debt is very different, right? If a startup founder takes debt from a VC or an angel investor, they lose control, right? Control in the sense that they are actually taking like an equity investment and they are losing a lot of control. So they have to, like, there's a lot of headache. But the point that I'm trying to drive home through this conversation is very simple, that when you're looking at PSU stocks, second key point that we are discussing is about PSU stocks. Please do not buy PSU stocks ever if you're not getting them at a deeply discounted price, right? No matter what the company is. End of discussion there, right? So that is a simple thing, and you can back test this. Okay. Now, what is the game that we are playing here? That it is at 29. If it goes to like maybe like 60, 65, right? Or even 70, you sell it off and you're done, right? So whenever an upswing in the market comes, my hope is that some of these PSU banks will go 3x, right? Why? Because banking sector is underperforming, and that would be the goal with which you invest in these type of companies. Now, this is not an advice, go and buy PNB tomorrow, all that stuff, nothing like that, right? So, okay. And why am I saying it? Am I just building like castles in the air? No. So if you take a look at it, revenues have been growing, right? No problem there. If you take a look at overall profits, it has been growing. No problem, or at least like it is at sensible level, right? I mean, it has grown over the last, what, like 6-7 years, it has been growing, right? So net increase has happened, right? Now, of course, there will be scams, there will be more scams, right? I mean, there are like a lot of shady stuff that goes in the government, whatnot, right? So they will give it to their friends, take money, free debt, whatnot, right? And nationalized banks are used for it, right? So they will always, that stuff will always keep on happening. We can't change it, right? But I can use my brain, right? So what brain can I use, right? So very simple. So for example, financials have not changed. Scams have already been uncovered. Therefore, PNB has taken a lot of beating. And when did the Nirav Modi scam happen? Right. So it happened somewhere in 2015-16, if I'm not mistaken. Right. So if someone can quickly Google it, right. So I think it happened somewhere here. It has already suffered a lot, right? This entire stock. And if you check the pricing levels of this stock, what is it that we are trying to say, right? So if you check this, right, so 2015, it was trading at 200 rupees, right, 220 rupees, whatnot. Right now, it has come down, fallen down by 90%, okay, almost 80-90%, right? Now, what is left in the stock to fall, right? That's my simple question, okay? And it's not as if that PNB will completely go to zero. And what more scams are you waiting for, right? I mean, Nirav Modi has already taken the money and run away, right? And Vijay Mallya has already taken the money and run away. It's nothing new. Even if another scam is come out, maybe it will fall by like another 20-30%, right? So yeah, fine, right? So you need to take a look at the upside or downside of things, right? It's the general rule is that please don't invest in PSU companies, okay? Generally, they will not give you returns. Why? Because it's just, they are not run to make profits, right? I will show you one more example here, okay? But the insightful point is that if you're getting at deeply discounted prices, price has already fallen by like 80-90%, right? It's not as if that you are buying an overinflated stock, right? Given the revenues and profits, right? Now people will start comparing it to HDFC Bank, right? We are not hoping that PNB will become HDFC Bank, right? We are not even hoping that it will become like a good bank. We are just hoping that, okay, some upswing will happen in the market. It's a highly undervalued stock, a lot of public interest, volumes are there, and someday it will move, right? So that's a simple analysis there, right? So put a little bit and see the magic, right? I mean, after a while. So this is called as swinging a stock, right? So that is what simple swing trading means. So you do swing trading based on opportunities, right? You don't do swing trading on every single stock out there. But some general rules, and two general rules that I've told you, that number one, please do not invest in commodity stocks. Please avoid that entire industry completely. Okay. Number two, please do not ever invest in PSU stocks. Worst thing that you can do is, I have always lost money in PSU banks or PSU stocks per se, like almost always, like not every single time. Oil India, I made a lot of money. But yeah, generally that is the key lesson that I've learned, that please do not trust the government, right? It just messes with you, right? So yeah, please do not do it. You will lose money. If you don't trust me, go and speak with LIC holders, right? So that's a problem. Okay. So please do not do it, right? That's a simple message. Our goal is very simple, that try to identify or at least invest 90%, 90-95% of our money on the right hand side of the value chain. Okay. Okay, so this is the first fundamental thing that I wanted to teach you today, that you can't really guess the prices. Number two, please don't invest in left-hand side of the value chain companies. Please invest only on the right-hand side of the value chain companies. And if you are swinging some stocks, it's okay to swing given the market conditions. So let me speak about a little bit about swinging, and then I will speak about ratios, hopefully in the next session itself. So there are three things that you need to keep in mind, and this is an execution class today, right? So I will talk about these 3-4 key things. Okay. So number one, there are three types of markets, and how you should be doing your selling and buying is this. Okay. So in an upward moving market, you should be selling stuff. Okay. And what is it that you should tell your brain that, okay, if I sold, like, if I bought some stock at 200, it moved to 250, I sold it, then it moves to 300. Okay, you made your profit, right? So just sit, relax. Please don't worry. You will never be able to optimize everything, right? That sell it exactly at the top, buy exactly at the bottom. That will not happen. Okay. Number two, in a downward falling market, keep buying. Okay. Keep buying for as long as you can, because the money that you make here or invest here and see in red right now, it all turns green very, very quickly whenever the markets start recovering. And no one in the world can tell you when the markets will start recovering. You will not even be able to realize it. Okay. Can I give you some examples? Yes, I can give you multiple examples. So after 2020, Mr. Warren Buffett was sitting at roughly $200 billion of cash. He did not deploy even one single dollar into the stock market. Okay, he missed the entire rally in 2021, and he is the biggest investor in the world, right? And yeah, so that is a fact, right? He missed that entire rally, right? Some people took his argument that, what's the point of investing, this, that, right? But now he is deploying money, right? So basically he missed the rally upward, but now he has cash, so he's deploying more money, right? So he has invested a $30-40 billion already. So even if he could not guess it, of course, you and I will not be able to guess it when the market is overinflated, underinflated. So we need to hedge and be sensible, right? And make money in almost every circumstance. So those are the strategies that I'm telling you, right? So I'm not promising you like stars and moons and make like 30%. I don't know how much return we will make, right? Next year, it depends on the market, right? How can I say how much return are we going to make, right? So here is optimization techniques. That's what I'm trying to tell you. So let us pick an example and let me clarify these 2-3 things. Okay. So let us pick the example of, let's say, a good stock. So let's pick HDFC Bank. Everyone would be knowing this. So what should you be doing, right? As per the rules that I've written. So if you take a look at last 5 years, let's pick. Okay. So this was 2020, right? If you are buying stocks here, right, at every fall, so let us plot. Okay, so let us look at downward falling market first, so it will become clear, right? Downward falling. Now, first question is that why did we pick HDFC Bank? Because it is a good asset. It is not a commodity stock. There is nothing bad. Fundamentally, nothing is off. All that fundamental checks. Okay, so therefore we picked an asset called HDFC Bank. Now markets have started falling. You keep on investing, right? So dollar cost average it. Every Monday you pick up, or every month you pick up. You keep on investing till the time markets are falling. It doesn't matter. Okay. Till the time it recovers, right? Or at least recovers like 50% of its value. Okay. So you keep on investing, right? Here, your simple goal is invest. And that is exactly what is happening right now. Okay. And you can back test it for 2008 crisis, 2020, 2022, whichever crisis, 2016, you just name it, you can test it out. Okay. Why is that? Because you will clearly see a big difference between this 200-day moving average. So let me quickly touch upon what 200-day moving average means. So 200-day moving average indicates the average price of a stock, okay, over the last 1 year. So 200 days, you will say 200 days on 1 year, because there are Saturday, Sundays off. So if you calculate all the chuttis, etc., then it gives you an average price of the trading of the stock for 200 days, which is approximately 1 year in stock market. Okay. So there is a huge gap that emerges between this and this. Okay. So this line, this I will highlight it, this black line, right? This black line and this blue line, there becomes a huge gap here. Okay. So this is a great buying opportunity. Now, bottom could have been formed like this also, right? It could have fallen even lower or whatever, right? So not zero, but yeah, I mean, very much close to zero, whatever. You keep on investing. That's the only thing that you can say. Now you'll say that, Akshat, is there a way that we can guess the bottom? The answer is no. Why? Because these days, markets are moving purely based on macroeconomics, right? Inflation concerns. People have insane amount of money and people will continue to have insane amount of money. It is their call when they want to invest in the stock market, okay, or any asset per se. Whenever they return to the market, the stock market will go up. Whenever they pull money out of the market, stock market will fall. That is a simple theory here. Okay, if both FIIs and DIIs start pulling out money, it has not happened, right? I don't think it has happened substantially for a very long period of time, but markets fall quite aggressively when both the parties start withdrawing money quite aggressively. That is when you should look into the market a little bit and look at the macroeconomic situation of a country. Okay. So anyways, bottom line is that why is it that you should continue to invest on a downward sloping curve? Because you can't guess the bottom of the market. Why can't you guess the bottom of the market? Because you don't control the Feds, you don't control the US government, we don't control how much money printing will happen. If tomorrow government decides that we are introducing a bailout package of $5 trillion to revive the economy, look at the market, it will run by 5-7% in a day. Okay, has that happened? Yes, right? So if you go and check, every time bailout announcement was made, 3-4 days before that, the market started running. And on the day of the bailout package giving, the market ran up by 4-5% because that was a confirmation of the news. Okay. So simple point is that we don't know when governments are going to give bailouts and, do like bunch of different things. So there is no point in us guessing. Okay. But we can definitely apply math, right? And math tells us that, for example, if your dollar cost averaging, then what does your average buy price become, right? Even if you are started purchasing at the top, right? So let's say here the price was, let me see what the price here was. So the average price, so the price here at the top was 1,300 rupees. Everyone with me, right? And here at the bottom, it was 800 rupees, right? So if you have been dollar cost averaging, what is the price that you will get? So you will get roughly 500, so 250 you add. So 1,050 will become your buying price, average buying price. Everyone with me? If you are buying every fall, okay. Now, if your average price is 1,050, then what happens, right? So this is where the recovery has happened, and you benefit immensely up until this point. Okay. Now what happens is that, see, now there are two types of markets that I'm talking about. So one is a downward falling market. The strategy here is fairly simple. What is the strategy? Keep buying. Okay. That's a simple strategy, right? Will the markets recover? Yes, 100% they will recover. Have they always recovered? Yes, they have always recovered. It might take 1 year, it might take 2 years, whatever year it takes, it takes. Okay. Your goal is that whatever new money you can invest, continue to invest in good assets. Done. Okay. This is the strategy in a downward falling market without getting aggravated, without getting frustrated. Okay. So you get a good average price of stocks. Okay. Then what happens is that whenever the market starts recovering, this becomes an upward trending market. Here, what is your goal? Your goal is sell overinflated assets. Okay. So this brings us to a simple selling strategy that here, sell at consolidation points. So what is a consolidation point? So this is a range where markets consolidated. This is a range where markets consolidated. This is consolidation. This is consolidation. This is consolidation. This is consolidation. So these are your opportunities to lighten your position. Okay. So roughly in each of these curves, you should keep on selling like 10% of your stocks. Okay. 15% profit booking. Keep on doing, right? And after a while, you get to a situation where this stock becomes free for you and hold it for long term, right? Or forever, whatever you call it. Okay. Everyone with me? This is the simplest thing. People give a lot of gyan around it, right? You know what? Okay, you should hold stocks for forever. You should not hold stocks forever. All this stuff. For me, holding Bitcoin is free now. Why? Because I've already booked a lot of profit. For me, holding HDFC Bank is free now. Why? I've already booked a lot of profit in 2020. A lot of stocks are free now, right? So I just plug it and I'm done. I've already booked my profits a lot. Okay. In this range. So therefore, regular profit booking is also very important. Easiest strategy to book profit is look for consolidation range, right? What exactly is consolidation? We will talk about in technical class, but I hope you get the picture that what consolidation exactly means. Everyone with me? So two strategies that we discussed, one in a downward falling market, one when the market starts going up, right? And how can you identify if the stock is getting overinflated? Very simple. See, till this point, there is no point in selling it, right? It's 200-day moving averages here, right? So you don't sell anything, right? At this consolidation probably, okay? Now here, the market is overinflated. There is a gap between 200 DMA. There is even more gap at 200-day DMA. There is even more gap here, right? There is still a gap, right? Here, it's coming back to sensible levels. So I will not sell a lot of it. Here, there is even more gap. So I will sell at these points, right? These are very easy indicators for me to sell. Okay, you don't need to put like MS, RSI, MACD, use Heiken Ashi, and 50 different technical indicators. You will not have the time to run through 50 different technical indicators. Your head will hurt. Okay, you can't do it on 50 different stocks. This is a very simple strategy that I'm telling you, right? Which anyone can execute and back test it. It works every single time. Okay, what is our goal? Number one, please buy good assets. What are good assets? No PSU, no commodities, half of your problems are solved. Okay. Number two, in a downward market, you will clearly see now is a downward market. What is the goal? Buying more is the goal in a downward market. What is the goal in an, because see, I mean, there will be a lot of idiots, right? I'm sorry to say this word, but people are idiots, right? I mean, it's as simple as that. Half of them, I don't know why they even do stock market. It doesn't make sense to me. They are just ruining their financial well-being. There are people, I'll make a video. Akshat, your X stock recommendation 2 days ago, it fell. Now, in a downward falling market, Marcellus Fund, for example, they have cut down their holding on HDFC AMC. We'll have a discussion on that. I will, in fact, release a video on that as well. Right? They sold their stock after 40% loss. Okay, plus they charge 2% PMS fees. Okay, if they were there on YouTube every single day, they would have been demolished by the Janta as of now. Okay, so that is the point. Okay, so I'm here holding my ground on things, and there are a lot of opposite positions that I've taken. For example, TCS, right? When Marcellus was buying, I was selling. Okay, when Marcellus stopped buying, I stopped. When Marcellus stops, when Marcellus is not doing anything, I'm buying TCS, right, at discounted prices, right? ITC, Marcellus sold it long time ago, 30-40% run up, I booked profit, moved away, right? Now probably they are entering into ITC, I don't know, right? So the point is that, see, people can be wrong. My goal is not to thrash Marcellus. Saurabh Mukherjee is like a good friend, right, from that angle. But what I'm simply trying to tell you is that any investor who takes like 10 bets, 5 or 6 bets will go off. It will go off for Marcellus also. It will go off for me also, right? That does not make them right. It does not make me right, right? That's how markets work. We all have our theories, right? For example, Saurabh Mukherjee's viewpoint is that buy and hold as long as ROIC, or return on investment capital, or ROCE is high. I don't believe in that. I feel that ROCE is a very good matrix, but it's a backward looking matrix, which I'll speak in the second part of the class. So every investor will come up with their own rule, listen to them, form your own investment style. That's the biggest tip that I can give you, right? You need to do things that makes you comfortable. You should not do things that makes others comfortable, for example, okay? And you will be wrong also, right? So out of 10 bets that you will say that you will take, you will lose money, right, on 5 or 6. So therefore you have to come up with a strategy where you're not losing big, right, so to say, and wherever you are making money, book profits, all that stuff, right? So please keep on doing that stuff. Please do not believe in the theory that you don't need to book profits. That's a completely incorrect thing. If FIIs, DIIs rotate 5-6% of their portfolio every year, what is 5-6%? They are actually booking profits most likely, or they are rejigging their portfolio. They are doing all that stuff. Okay. So please, you also do the same, right? That is the beauty of buying individual stocks. If you're not rotating your capital, booking profits, then it becomes a problem. So I hope this brief discussion so far, it gave you strength as to what you should be doing in a downward falling market. Buying more, that's a simple objective. Keep buying, keep buying. Don't even look at your portfolio, how red it is happening. Okay. What happens in an upward moving portfolio? You have stuff to sell, right? Right now we are holding stuff, right? We are like, we know that onion prices are going to go up, so we are wholesale traders from that angle. So that is exactly what we are doing from that perspective. So you just simply do that, right? Buy like good stuff, right? That will go up in a good market. That is the market you are preparing for. You need to display that second order thinking. People do not think beyond one step, and that stock market is not a place if you are just having one dimensional, one step perspective that, hey, I buy it today, it should start rising tomorrow. That is extremely short term. If you are such short-sighted, you will lose money, right? You will lose patience, you will move on to other things. Okay. So yeah, I hope this gives you confidence. And this also portrays the central message of this entire course, that why is holding power so important, right? Do I need to sell something like PNB? Do I need to sell something like HDFC AMC? No, right? I can wait for it to recover. Okay. Yeah, so that's a simple message. But yes, if you are trading on loan, if you have taken loan and are, sort of fighting in the stock market, then it becomes a slight issue, right? All right, so let me talk about 2-3 more points, right? So what happens in a sideways moving market? Let me display it. So sideways moving market is very easy, okay? So sideways moving market, what you need to do is trading view. Okay. All right, so On a sideways moving market, you need to trade the channel, right? So let's pick any example, right? So let's pick Page Industries, okay? Or let's pick HUL for example, okay? So this is a sideways moving market, right? Now, how do you check a sideways moving market? That there will be a substantial period of time when the market will move in a certain channel. Okay, so what is channel? Let me draw it out for you. So this is a channel. Okay, so I will draw it. So this is a channel. Okay. So this is how you draw a channel. You just pick two random points, right? And you extend the line. So I've picked these two random points, extended the line, right? So this is called as resistance. And this is called as support, right? So support means that the stock prices touches, goes back up, touches, goes back up. This is the resistance point that touches, falls back, touches, falls back, touches, falls back, touches, falls back. So the stock is moving between these two lines, right? Resistance and support. Everyone with me? Just a second, I'm not able to see you guys. Yeah, so everyone with me on this, what resistance support is, right? Now, in a sideways moving market, what ends up happening is that, the stock will go up, right? Then selling will happen. Then, it will fall down. Then again, it will go up, selling will happen, it will fall down. Then again, it will go up. So this cycle keeps on repeating. So your job is very simple. They draw a channel, right? And basically sell here and buy here, right? So whenever it touches this line, buy here. Whenever it touches this line, sell here. That is all you need to do. And this is a very important channel. Now you might say that, Akshat, you know what, there is, this thing is not playing out now, right? Why? Because the stock has corrected quite a lot, right? It has fallen, right? It has broken this channel. Yes, it has broken this channel, right? Now, whenever the stock returns to its channel, it is likely to display this behavior. I'm saying likely to display this behavior. It is not guaranteed that this will happen, but there is a very good chance that this channel is a very strong channel. Why strong channel? Because this up and down game has happened multiple times here, right? So most likely this trend will continue for a little while. So whenever the stock re-enters it, what becomes your selling point? Your selling point becomes the extension of this channel. Everyone with me? Right? So that's it. So that's what you do on a sideways moving market. That's what you do on a downward falling market. That's what you do on an upward falling market. Goals are very, very different. And again, how can I explain it? Yeah. So so goals are very different, right? So it's like you preparing for an exam, right? So 1 year before the exam, what do you do? Do you study 12 hours a night? Most likely no. But the goal of the exam changes completely 2 days before the exam. So do you study 14 hours a night? Yes, right? In fact, people like me study like 20 hours, right? Night before the exam, because we don't study much before, right? So anyways, so the goal is very different of every market. The goal of every market is not to make money and book profits, right? So that's a simple message that I'm trying to give you. Please understand it, because if your goal itself is wrong, then you will of course not have any strategies around it. Okay. So I hope these strategies are clear. So 4 or 5 key points, please note it down. Number one, that please do not, when it comes to buying assets, I will give out more points subsequently on the course. But 2 critical points are that please do not buy commodity stocks, right? Unless you're getting them at a huge discount. Number 2, please don't buy government-oriented PSU stocks, right? Unless you're getting them at a huge discount. Okay. Point number 3, that trading strategies will differ from market to market. Now, the goal of an upward moving market is to book profit. The goal of a downward moving market is to aggregate stocks. And goal of a sideways moving market is to trade the channel for as long as you can. Profit booking from time to time is mandatory. If you're not booking profits, then you're not making any real returns in the market. Okay. So that's the simple message that I'm trying to give. Also, one more important point you can add: please do not invest in IPOs. Any IPO, it doesn't matter. Okay. So it's pointless. There is just no benefit in terms of investing in IPO. The information is stacked against you. IPO is a great game for Zerodha, Grow Up Stocks, all these companies, that they get to open many accounts, because again, like, people are idiots, right? I mean, they hear like, this company is coming, that company is coming, they get excited, they buy 10,000 different shares. So, but it is just like good for morning walk talks, right, with uncles in the park. But beyond that, IPO investing is pretty much nonsense, right? So please do not do it. There are much better things to invest your effort and time on. Okay. So this is the third key point. Now, before we take a break, I just want to sort of give you like some MBA concepts, right? So this is like a mini MBA, and there are 4 or 5 basic things that I will tell you, right? So this is like if you go to a business school for 4 years or like 2 years, sorry, not 4 years, 1 or 2 years, then what are 4 or 5 key points that you should know about stock market? Business school will also not tell you. So I will tell you, okay? Now, businesses deal with 2 problems, okay? And there are 4 things, literally 4 things that I will tell you. And this is a mini MBA that I'm helping you do from a stock market perspective. So first thing, right, that all the verticals work together, right? Now, what is meant by verticals? So verticals are marketing, operations, finance, strategy, whatever, right? Ethics, right? So all these are verticals, right? For a classic case in point is that a company can do magnificently well, but if it has ethics problem, it becomes a laughing joke. For example, Ashneer Grover's company, right? So it's a joke, right? So I mean, whatever is happening with the management, right? Same goes with Ankiti Bose, right? Zillingo founder, it's a joke, right? So they are like, I don't know what they're doing. Same happened with a guy named Housing.com CEO, right? Rahul something. So all these, so ethics is also a very important vertical of it. Okay. So please remember that that a business comprises of different arms. All arms need to work in tandem, right? Otherwise, it becomes a problem, right? So finance also should be good. Operations also should be good. Brand value, marketing should also be good. Right? So this is the first basic point, that in order to define something as a good business, all the verticals need to be in sync. Okay, this is the first key critical lesson that I will talk about. Now, what is the second key point that I can talk, right? So businesses, basically a related point here is that businesses through these different verticals are trying to solve 2 problems. Okay, one is called as engineering problem. Second is called as brand or marketing problem. Right? That's it. Okay. So if we just had 2 verticals on a business, this would be okay. These are the 2 most important verticals. Engineering vertical simply means that what type of product are you coming up with? So Apple comes out with a wonderful laptop, right? How useful that product is. Are customers going to use it? Is the company able to innovate and design the next generation of product? So you need to have high faith in the engineering capabilities of a company. Okay. People are betting big on Tesla because it is solving some crazy engineering problems, right? So Tesla's value, half of it is generated because of the fact about the type of engineering problems it is capable of solving. Okay, I'll say it again. It is a type of problem that it is capable of solving. Now, how do you judge that capability? You judge the capability by looking at the past performance of the company, right? So, for example, when it comes to artificial intelligence, machine learning, self-driving cars, so Tesla has built a mini city. They are running a series of experiments. So they are solving some of the toughest engineering problems on Earth. Okay, so this is one. So engineering problems or ability to solve hard engineering problems is very, very important for any company to stay relevant, right? Again, going back to some of the previous examples that I have spoken about in the course, why did Kodak go away? Why? Because it was an engineering problem. It was not a marketing problem or brand value problem. It was simple engineering problem that they could not assess and adapt to. Okay, so that is one. Same I see happening with boAt. Lot of hoopla, right? That hey, boAt will become like launch its IPO, do wonderful things. My perspective, and I can be wrong, that I don't think that they are solving engineering problems correctly. Great marketing, right? Lot of good things, but hey, I don't know if they will be able to solve the engineering challenge that the company has. Okay. Now comes the second problem, which is the marketing problem, right? So marketing means branding, right? The better your brand, the more you are able to command the prices, and you become a Titan-like company, right? People buy. There is a reason why the stock price of Titan has increased so much. The reason there is fairly simple, that there is a brand associated with it, and therefore there is a huge difference between the book value and the current market price. The difference indicates the pricing power of a company, right? Same goes for Apple. If you go and take a look at the difference between book value and price, you will see huge difference between them. Okay, so this is a marketing / branding thing, right? Which is the second key challenge for a company. So whichever company you see solving these 2 issues, in very simple words, it's a good company, right? Will it survive? Will it not survive? Will it give stock market return? I don't know, right? A lot of the things depend, right? Building a company is like raising a baby. You can't predict the future of your own baby, right? Despite you spending all your life with them. Similarly, you can't predict the future of a company, but at least you can look at the fundamentals of a person Similarly, you can look at the fundamentals of a company. So this is what is meant by looking at the fundamentals of the company, right? Now, can I give some example of marketing and why am I bullish on Zomato, right? So at this point, right, not like 6 months, 10 months ago, right, I feel that they are solving engineering problems. They are capable of solving it. So they can make that 10-minute delivery stand out, which is a huge game changer for the company. And they are very good at marketing, right? They are very sensible when it comes to social media, very smart. Amul, same thing, that they are smart when it comes to handling their engineering problem. How? Because aggregating farmers at the back end, getting them to supply you material, right, which they can process and sell it at a higher cost. It's a game that a lot of people have played in India, but only Amul is one standout company, and maybe Mother Dairy is another one that have been able to win in that game. So it is an engineering problem that they have solved. Now, engineering can be operations, it can be machine engineering, it can be product design, it can be UI, UX, website design, whatever. But this is the fact, right? So they have, these two companies have solved that engineering and branding problem both. So a company should be good. A company should be really good at both these areas, that it should be good at solving engineering problems and it should be good at marketing and branding problem, right? As long as both the things are happening, it's a good company. If you do mota math, and if you just take care of this one framework, you will be able to identify good companies, right? So why am I bullish on Zomato? Very simple reason that, hey, it has, market is already maturing. So from a market or industry viewpoint, it's a mature, needed industry, right? It's not going away. Second key thing is that Zomato is branding, has solved complex engineering problems already. It can solve and bring in more innovation in this field. It is already trying to do that. And finally, it is a company that is that has great branding and marketing power, and it is leveraging it, right? So 10 years from now, my hope is that if Zomato sticks around, it will become a highly profitable company, right? And it will be able to survive, right? So that's my viewpoint. I can be off, right? So if I make 10 such bets, I'll be off on 5 or 6. But 3 also, if I win, I will be a net profit aggregator, right? So that's the vision with which I'm speaking. Okay. So, right. So that's what I would say. Now, third key thing, right? Please think now, there are some categorizations that I've given that will help you understand it. So you can read more. That's why I'll not get into it. Second key thing, right, that you should remember in terms of identifying good companies is very simple, that you should remember the simplest finance formula that is out there. So what is the simplest finance formula? It is profit is equal to revenues minus cost. And there are two types of businesses that are generated from this talk, right? So one is that companies like Hindustan Unilever, Nestle, which are already generating profits and which are already generating revenues. So they are good companies, right? Good assets, right? At what price you buy them, that's a separate conversation. But as an asset, are these companies good? Yes. Why? Because they are making money. Or there should be a company that has a very high probability of becoming profitable in the future. For me, it is Zomato, right? So I can be off again, right? But that's what I would feel. Okay. Third point that you should remember from the mini MBA thing is synergies. And there is something called as economies of scale and diseconomies of scale. Okay. So this is a very interesting bit that you must understand. For example, WhatsApp, right? Or Meta, right? Now, why am I bullish on Meta? Simply because of the fact that they have access to roughly 1/5 population on Earth. I'm not saying 1/5 population of US. I'm saying that 1.5 billion people, or more than around 2 billion people, use Facebook oriented products every day. Okay, so that is what their daily average users, not daily, but like overall reach of Facebook is. Okay, so if they are starting WhatsApp payments or whatever it is that they are trying to sell, they will be able to do it. It's a very smart company from that aspect. So that is a synergy play for Meta or Facebook, that they will launch a series of different products. They are already launching it. They keep on doing it. So even if their primary breadwinner, which is Facebook, if it goes away, withers with time, they have other things to bank on. And in fact, if you look at the performance of Facebook, Instagram is much more profitable compared to core Facebook. Okay. And Instagram is something that they acquired back in 2012, if I'm not mistaken, right? Somewhere around 10 years ago. Right. So yeah, so they're already working on like next gen things, right? So that's a smart play. This is a synergistic play. Same is the play that is done by Apple, Amazon, that they are all building different components. For example, you have Apple laptop, you connect an AirPod, you connect it to like Apple dongle or whatever it is, right? And you have an iPhone, right? So everything connects. You have AirPod, right? You have like photo sharing and whatnot in it. So this is synergy. There is a reason why all the electronics companies are building a range of products, because they want to create an ecosystem of devices. So that is synergies. That is called as creating economies of scale, right? This also exists in traditional form of businesses. For example, a traditional form of business would be that if Amritanjan has already excelled in terms of selling their pain mount, right? Now they get into second product. They keep on building that concentric circle that I was speaking about. So this is called as synergies, that in order for Amritanjan to sell like sanitary pad, a market in which they are getting active, they will not have to create distribution from scratch. Okay. That's a simple basic outline, right? For example, in my case, I'm trying to build a startup where I will try to, it's a free news-based about stock market and crypto startup, right? Very similar to InShots, right? So I'm working with some of my students on that, right? So do I need to create new distribution? No, right? I mean, I already have an audience that listen to me on like finance, stock market, economics. I will just tell them that here is an app that I've launched. Do you want to go check it out? It's free. So almost everyone, right, who follows me would go and check it out, right? So it's a solving a distribution problem. It's just expanding from one mode to the next, right? So it becomes very easy. But if I were new, completely new, if I would have not worked on my distribution, so to say, then the problem becomes, and I have to go and spend crazy amount of money to get 50,000 people to download my app. Okay, so there is a huge advantage between these two. There is a huge advantage in having certain kind of expansion mode. Same goes for Tesla. Now through what medium Tesla sells most number of cars? Right? The answer would be Elon Musk's tweets. Okay, so it's not like they have some great sales agent, this that. Elon Musk tweets, people go and buy 100,000 Tesla, done, right? So he does not need like to spend like crazy amount of money in marketing. Okay, great, you are Ford, right? You have like crazy amount of money. What are you going to compete, right? He has like zero advertisement. He has zero cost, right, in terms of like his marketing, right? From that perspective, right? He can sell it online if he wants, right? So people will still buy it, right? So that's the advantage that people have. So look for these type of synergies in businesses. And I genuinely feel that content creators, like in 10, 15, 20 years, they will become unicorns, right? So it is given, right? The way where the world is headed, okay? So yeah, learn about it, learn about writing, right? How to write well, get started on LinkedIn. If you want my support, I'm very happy to help, right? In whatever capacity I can. If you want me to organize like a separate session on content creation, I'm happy to do it, right? Outside the course. Not an issue at my end, right? But the bottom line is that this is an industry which is growing. And if you can become a good content creator, try to become it, right? I do not call myself a content creator, right? I mean, I just anyways love to teach always. So I've been doing it. But yeah, if it interests you, please do it, right? Now comes the fourth and final point for the mini MBA thing. So this is economies of scale, right? And fourth and final is the firm should be able to withstand competition. So this is called as moat generation. So whatever is the brand value of the company, will it stay intact? Or whatever is the winning advantage of the company, will it stay intact? A classic case in point is Tesla. So do you think that Tesla has a great succession plan after Elon Musk? So that is an interesting question, right? So if you're investing in Tesla for the next 10 years, 20 years, I don't know, right? It's a one-person dependent company. So do you feel comfortable investing in it? And what will happen to Elon Musk if his tweet, or what will happen to Tesla if Elon Musk tweets go away? Okay, so that's a very interesting thought process. So let me know your answer. Okay. All right, so what we are going to do is that we are going to take like a 15-minute break, and then we'll be back. So we'll meet at approximately 8:22. Okay. Cool. So I hope you made notes out of this, and next session we will go deeper into like individual companies and how to do competitor research.